Number one, if you are flipping houses, building spec houses, if you are buying and selling real estate and trading real estate, it's all about how you buy. You've heard the saying, you make your money when you buy. So you have to buy under market value. And now more than ever, buying right is more important than ever. And a lot of people can make the mistake in overpaying for property right now because there is such a big demand. So one of the questions I get asked all the time is, what's a good margin for flipping a house or building a spec house? So generally, if you're doing 10, 20, maybe even 30 projects a year, you want to have, if you're doing a full rehab, a meaningful rehab, or building a spec house, and a meaningful rehab is if you're spending 3 or 4 months working on it, then you want to have a 25 to 30% margin after all expenses. So you need to buy the house, repair it, and be able to sell it with enough room for you to make a 30% margin after all expenses, including any kind of taxes, not like income taxes, but any kind of local real estate taxes on the transaction, like transaction taxes, deed stamps, things like that are paid, closing costs, commissions that you might pay a real estate agent, all that kind of stuff. You want to have a 30% margin after all costs, if you can, in order to guard your profit and make sure that you have enough room in the deal. If you're building a spec house, kind of the same thing. Now, if you're doing a ton of volume, you can lower your margin a little bit because you can make it up in volume. And if you're doing a quicker, more retail cosmetic flip, you can lower your margin a little bit. So all you got to do is buy it, clean it up, maybe a little bit of paint and sell it. You can maybe run a 10 or 20% margin. A lot of it is the return on the cash you have invested. So if you're borrowing the money or using hard money or private money, then the return is going to boil down to the cash you have out of pocket or invested, not what you're borrowing. So back in the day when I built a lot of spec houses, I borrowed the money to build those houses. So all I had to put in was the down payment of 10 to 20%. So my cash on cash return was based on that, not based on the loan amount, because the money came from a third party and there was a rate of return I paid on that. So you want to look at what is your outlay, what are you putting into the deal, what's your return on that, and then base your decision on that. And you might be good with 10%, you might be good with 20%, or you might want to see 30% or 100% return on your cash. So whatever those parameters are, make sure you know that going into it. And remember, you make your money when you buy in real estate. You want to buy below market value. You want to buy at a price point where you can make a profit. And if it's a short-term project, in and out, retail flip, or wholesale, a lot of people call it, or even wholesaling, then you can operate with less of a margin. If you're doing any kind of a substantial renovation, a longer-term project, then you want to build a bigger margin in it. New construction is going to take you a while, so you want to have a healthy margin in new construction, 20, 25% there. And if you're developing land, you want to have a 30% margin there.